This is the slightly late current federal tax developments for April the 16th, 2025. Current federal tax developments are brought to you by your state society of CPAs. I know that this is a little late because obviously we have just finished up with April the 15th, and I was a bit devoted to getting the end of tax season done before I recorded this week's information. And it's interesting because we had a lot of developments in the week in question, which was kind of, for me, of course, a bit, shall we say, inconvenient because a lot was going on in a week where I didn't have a lot of time. So we're going to talk about those things here today, see how things are going, and we'll talk a little bit about what's coming up. Obviously, knowing the way the luck works, next week we'll have virtually nothing. But we'll see. So far, I think I've gotten one thing I can put into next week's broadcast, so we'll go from there. This week, though, we're going to talk about a few things coming up here. First, we're going to take a look at a couple of state tax cases this week, and that's somewhat important because they do make a difference. We'll talk about Massachusetts source income and the sale of stock by a non-resident. How in this case, a non-resident selling stock in an S corporation ended up finding that the gain on that sale would be treated as Massachusetts state income. We'll talk about why and what happened in this case. We have a valuation case, Pierce versus Commissioner, looking at valuation of a stock sale. It's an interesting case primarily, to be totally honest, in kind of the soap opera story behind it and how the taxpayers' personal problems, shall we say, ended up personal problems and somewhat questionable business model ended up actually being considered in the valuation of gifts that were made of the interest in that entity. So about personal liability for corporate sales and use tax. This is another state tax case. I want to talk about this because I think a lot of times people neglect the fact that it's not just federal responsible person penalties that we have when we look at the issue of trust fund taxes for payroll, but most states will impose an equivalent of a trust fund tax on a sales tax situation that they've got. So we'll talk about why in this case the taxpayer ended up finding that, yep, she was liable for sales taxes for the business that had closed. We're going to talk about a loss with an ERC consultant who was trying to get some, shall we say, relief from the IRS's ERC processing moratorium and their risk-based scoring. So we'll give you a background on that case. Going to talk about the paying the full amount of the tax due before suing outside of the tax court. We'll talk about that regarding a taxpayer who filed an amended return that ended up giving a net, ended up computing net tax due, actually net refund due. IRS, when they examined it, examined the claim, discovered that there was, in their theory, there was tax due. They disallowed the credit, which was the big thing that was generating the reduction in tax, and in essence went after the taxpayer for an increase in tax. We'll talk about why the taxpayer needed to pay the full increase in tax before they could sue under these facts. We'll talk about the special rules for dependency claims and child tax credits. This is the divorced parent and the misunderstanding that a lot of people have that essentially, no, it's not the parent that files first that gets the child. And also the special rules that apply. It doesn't matter if you had some sort of side deal where you and your spouse had been kind of ignoring the written agreement. And most importantly, why, regardless of any agreement, it really only matters who had the child the most nights. And once we figure that out, if the other parent can only claim dependency exemption if they get a signed release that they submit with their return. And so we'll talk about the reality of a dependency claim versus the misunderstanding, because this case is probably a great example of how it's misunderstood and why we have issues. We'll also talk about a charitable contribution deduction and valuation issues that arose here in the WT Art Partnership case. In Zajac, going to discover why it's really important to keep good records. That'll be key. We're going to talk about a taxpayer who got creative about being forced by a court to basically return ill-gotten funds, and how he essentially, he didn't have the funds, but the S corporation ended up with money which was taken from the S corporation. He was saying, well, because the S corporation was never convicted, that is not against public policy and not against 165F, so I can claim the loss on the assets seized from the S corporation on my return. We'll discover the courts and go along with that. We have the most recent update to the SIFL rates for valuing aircraft, basically for valuing aircraft rides when you're an employee and you're riding along on the aircraft, with company aircraft, what's the value of that for purposes of taxation. We'll also talk about the IRS's limited penalty relief for certain micro-captive insurance setups, their disclosure statements. And finally, we'll talk about the official demise of the DeFi broker reporting regulations that were going to take effect in 27. They're not going to take effect at all. We'll talk about House Joint Resolution 25. The first case is we're going to take a look at Massachusetts source income and the sale of stock by a non-resident of the state of Massachusetts. This looks at the case of Welch v. Commissioner. This is number 24-P109. This is from the Massachusetts Appeals Court, and the decision came down on April the 3rd. Now, the facts of the case. Craig Welch founded AcadiaSoft in Massachusetts in 2003. Craig worked exclusively for AcadiaSoft in Massachusetts from 2003 to 2015, holding various executive roles. So he's the founder of this, right? He moved to Massachusetts in April of 2015, becoming non-resident. In the interim, of course, he had kind of sold, basically transferred the company, sold out, now he's going to get bought out. In June of 2015, he sold his stock for significant gain after resigning his positions. In fact, it was contingent on the stock sale going through, basically his leaving employment, etc. It all went through. Now, the Welches did not tax this to the state of Massachusetts. They excluded it on their Massachusetts non-resident return. Essentially, he did what a lot of people would do. The reason why he's in New Hampshire is no income tax. So he left Massachusetts, and in 2015, essentially after moving to New Hampshire, he sold his S corporation stock. Question: can he escape Massachusetts tax on this? And he's going to rely on the fact that the regulations under a law change said that generally the sale of stock is not considered source to the state of Massachusetts. The central issue here, the key points of the law that are going to play here, which is state law. It's important to understand every state has its own laws. It's important to double check things here. But this was where the gain from the stock sale was Massachusetts source income under Section 62 and 5A and 830 of the Massachusetts regs, basically, or I should say of the code, and then of the regulations. Now, in 2003, there was an amendment to Section 5A, 5 Cap AA, that broadened the definition of Massachusetts source income to include income attributable to a past trade or business. That regulation does state, the regulation interpreting this law stated that, excludes capital gains from the sale of a CRS corporate stock from Massachusetts source income, but with an exception. Such gain may be Massachusetts source income if connected with the taxpayer's conduct of a trade or business, including employment, as in a case where the stock is related to the taxpayer's compensation for services. And the court agreed with the state that the generally does not apply language that says, the regulation generally does not apply to sale of capital gains on sale of your CRS Corp stock. In the regulation, that language itself means it's not an absolute bar. In this case, the taxpayer was relying on this as saying, look, the regulation says I don't pay tax on this in the state of Massachusetts. The court says, no, it says in general you don't. But in general doesn't mean always. So the board, the appeals board concluded that Welch's gain was compensatory, and it was derived from his employment with AcadiaSoft. Okay. Now, the appeals court deferred to the board's expertise in this area, and key factors that supported the conclusion that this was compensation based on basically this was related to his work, his employment with Acadiasoft, which made it Massachusetts business source income, was that he founded the company and acquired the stock shortly thereafter. So, he formed the company. This is a founder, right? He dedicated over a decade to building the company's value, which a lot, founders do that, right? The point of this thing was to build it up and then essentially be able to sell it off, right? Find a buyer who would take it over, take it public, and, be able, therefore, to extract your value that way. He did clearly expect a return for that sweat equity, right? He was not being compensated totally adequately for, what he was doing because he was building value in the company. That was what he was trying to get. That was what he really expected the major return to be. His agreements with the company and with others linked his key holder status to his employment. That basically there were rules that tied him in there. And his resignation was contingent on the stock sale, right? He wouldn't resign his position unless they bought the stock. The stock sale went through. Now, he had cited a case, Oliver, and the court distinguished the case because it was prior to the amended statute. The amended statute that was enacted in 2003 has a broader reach. And it didn't matter that the stock was never claimed to be given to, Welch as compensation, because obviously he formed the company, right? Basically, the stock was what he got when he started it. But the idea was, his holding that stock, continuing to work in Massachusetts, was related to get that value up so a buyer would give him significant extra value for the stock. Now, the appeals court affirmed the board's decision. So he said that gain was taxable as Massachusetts source income because it was intrinsically connected with his trade or business or employment in Massachusetts that he had, right? Remember, he moved to New Hampshire and 2 months later had this gain. So they're saying, no, you can't just leave the state in a case like that when you had been working all along to get this value up. That's why you were dedicating all those hours. Tough luck. Now, the key implication for those of us in practice is you got to carefully consider the underlying relationship between stock ownership and employment or business activities in at least Massachusetts. And note, this fact pattern is something you'll see a lot, and I have seen it happens. And it's a type of, we'll call it quasi-planning that a lot of taxpayers do or founders. They'll build up the value of the company. They're in a high-tax state. And quite often they're in a high-tax state because that's actually where the economic activity is, right? So they got to run it there. But just before they sell, they relocate to a low or no tax state. The state of California, seriously believes that's the whole point. Nobody really lives in Las Vegas. That's the idea. They don't live in Nevada. They just claim to. Now, California is more likely to attack it based on claiming you still have too many links to California, you're really still a resident. But in this case, Massachusetts is saying, I don't care if it's really clear you no longer have any links to Massachusetts. That's not relevant. We're not claiming you're a resident. We're just claiming this is Massachusetts source income. Okay? And also, when you're reading regulations, when you're reading, that sort of background, laws, etc., you got to watch out for phrases. Generally does not apply means there are cases when it does. So you got to be careful that you don't lose track of the fact you're going to have a case at will. So in this case, in Massachusetts, you're going to analyze the timing of stock acquisitions, the taxpayer's role in the company, and did he have agreements linking the stock to his employment status, right? As he did in this case. And in this case, Massachusetts sourcing rules for income derived from activities within the Commonwealth have a very broader than normal reach even after residency changes. But the big takeaway from this is, watch out for states. Don't just assume that because a client, heads for the border, right, and gets themselves in a low tax state and then sells their closely held company, that they're going to escape taxation in the state. At least the state's going to view it. And over time, the federal courts have not been very apt to get involved in this. In fact, if anything, the Supreme Court, after we saw the Wayfair sales tax decision, seems to indicate it's even less likely we're going to see them get involved in any case like this. Their argument has been for a long time the Constitution allows Congress to deal with this, and Congress just never deals with this. So it's an issue, but be careful about that kind of rapid fire tax planning, where you just say, okay, just move out of your high tax state, move to Florida, move to Nevada, right? Move to Washington, and you'll be in great shape. That doesn't always work. Okay, let's talk about valuation here with a gift of a closely held business interest. And this is a case of Pierce versus Commissioner, Tax Court Memorandum Decision 2025-29. The decision came down on April the 7th. Let's talk about the facts of this case. Now, Caleb J. Pierce gifted and sold interest in Mother's Lounge, LLC in 2014. Right. The reported values were based on a valuation report. Now, that valuation report took into account that you needed to reduce the value of Mother's Lounge due to a couple of factors. The soap opera part of this was that apparently Caleb had been cheating on his spouse. Okay, fine. But that's kind of bad when you're selling to new mothers. That could be bad publicity. Number two, one of his employees had discovered Caleb's cheating and was attempting to blackmail him. So, of course, he had to confess to his spouse. And as you might guess, all kinds of weird, bad things happen, including the fact that Caleb is no longer married to that spouse at this point. So he had a lot of things go on. And Mother's Lounge had an interesting business model. They gave away free items. They basically, their give was, just sign up with us and we'll give you free some sort of very, cheaply made sort of item that a new mother would need or an expecting mother would need. And by doing that, right, we're going to give it to you free. Well, of course, obviously, you don't give away everything free and make it up in volume, right? You don't have a margin there. So what they were doing, not surprisingly, is putting in a really significant markup on the shipping. And they didn't really make clear how much that would be until the person got fairly along in the process of asking, of getting this free stuff shipped to them. And by then they were committed. And the catch was that in many ways, what they did was they got things made very, very cheapest way possible, but it kind of looked like something you would normally pay for. So that was kind of the way the business ran. Now, over time, that had become more difficult because it turns out that various places like Amazon began cracking down on things like this. It also turns out that, spam blocks were coming in. A lot of this was being blocked, and so they're having a lot tougher time doing this. They also had a deal with a store that basically, sold to this same category of people, but they kind of deceived them into believing that these guys were wholesalers and therefore they were just, they're going to provide this free samples to their customers if they put coupons in the bags. And of course, they would then use that to take them down the path and finally getting to the shipping charges and charge huge amounts. But the company was under the impression that Mother's Lounge was a wholesale operation, not effectively a competing retailer. And they actually did. They attended at not insignificant expense a number of wholesale conventions for that industry, largely to just keep up the appearance of being a wholesaler for this customer they were working with. So as you say, it was an interesting business model. And the person that valued it, basically, nailed it to a certain extent, which, by the way, the court will agree with, for the fact that that model was dying and questionable at best. And number two, all the bad publicity and effects and impacts of, Mr. Pierce's infidelity and the blackmail and all the other, So as I said, it was an interesting set of cases there, right? Now, The IRS, though, said, no, this thing's been very profitable. They raised the value. And Mr. Pierce challenged the IRS determination in tax court. He argued for lower values that there was adequate consideration for interest sold. Because what the IRS was claiming was, not only did he had gifted interest, and he said you undervalued that, but you also, the ones you claim to have sold, it really were worth more than you sold it for, so that's also a partial gift. So this is a gift tax case. Now, under gift tax, section 2501, a gift tax is imposed on a transfer of property by gift. The value of the gift is the fair market value on the date of the gift under section 2512H. For a closely held income, the income discounted cash flow method was deemed the most appropriate for Mother's Lounge, right? And what you do with discounted cash flow is you take projected future cash flows, and we do consider what's called tax affecting. That is, because it's an S corporation, there's going to be a tax impact on that, even though it won't occur at the entity level. It will occur when it gets to the personal return. And so there is a reduction at cash flow for the income tax that the buyer is going to have to pay on that flow through income before they can really get to cash. You can't keep all the cash. And in this case, they're going to use the Delaware Chancery method. So we'll leave more details there. You can read the case and look into it. You apply a discount weight, weighted average cost of capital. There's a build-up method for the cost of equity, excluding double-counted risks. And then the terminal value, just what are the assets worth there, getting rid of it. And are there significant non-operating assets? Are there excess cash not needed for the business in there? And that gets you kind of the values. And then you take discounts for lack of control, lack of marketability for minority interest. Now, in this case, the court went through in a lot of detail the expert's report, and it actually picked apart and chose some from the IRS and some from the taxpayers' benefit. They mainly, though, rejected the IRS's experts' projections as uncorroborated knockoffs of the work the taxpayers did. So generally, the court leaned toward the taxpayer's expert, right? It accepted the taxpayer's tax affecting rate, said, yep, that's the proper way to handle it. It did accept the IRS's experts' base cost of equity, but rejected the petitioner's specific, company-specific risk adjustment, accepted the long-term growth rate and excess cash calculation of the taxpayer, and accepted the petition's discounts for lack of control and marketability. So it accepted portions of both reports' derived valuation. So a final valuation number was not provided, but they sent for a Rule 155 calculation, where the parties will, in accordance with the court's instructions, work out the actual value and tax. Key implications of this, really important to, have a thoroughly documented and independently corroborated valuation of very good expert's report. The IRS was hurt here by the fact that their expert really just kind of, tagged on to what would have been done by the taxpayer's expert, and did a little bit of sniping and changing things, but basically didn't really have his own really good one. He just kind of took what was there. You got to clearly articulate and support all underlying assumptions. Consider all relevant facts, include recent industry trends, the company's specific risks in this case, and management decisions. Come up with the appropriate valuation methodology. In this case, why was the discounted cash flow method the best way to go? Now, the court did indicate skepticism in how discount rates are arrived at. Kind of saying that it's really more, we would tend, there's certainly an impression, the court didn't really say this, but there's an impression that we know the value we want, and then we figure out what discount rate we need to get there, and then we, come up with a justification for that. Make sure, if Apple, use a recognized method for tax affecting. This one looked at the Delaware Chancery method. And also use relevant studies and company-specific analysis to justify your discounts. And again, that's going to be the one the court's going to be most skeptical of. So that's going to be the key issues to look at that. Now let's go to states again. This is the state of California. And this is personal liability for corporate sales and use tax. This is the matter of the appeal of Wageman. This is from the California Office of Tax Appeals. Decision came out on February 11th, just now got kind of published generally. Now, in this case, B. Wageman appealed a decision that held her personally responsible for Pit Pro Cycle's unpaid sales tax, interest, and penalties. Now, Pit Pro was equally owned by Ms. Wageman and by her spouse. Now, she served as president, vice president, and CFO, and conceded she was a responsible person for tax compliance. She was in charge of filing all the reports, right? Now, when the state of California came in and looked at this, they found a significant discrepancy existed between Pit Pro's reported cost of sales and the taxable sales. Like, they were apparently selling everything at negative margin, if you believe them. And of course, the state of California didn't believe them because that's kind of a dumb way to operate your business. So, following an audit revealing substantial understatement, Pit Pro went out of business. There was this huge assessment coming against them. So they just disincorporated, which, okay, tough luck, state of California. The corporation's bankrupt. You can't, it's basically you can't collect the money from there. And that's tough luck because we all know, of course, corporations have limited liabilities. But this is when we get to like the federal trust fund penalties, right? The responsible person penalty and the trust fund penalty. The same thing is true for sales taxes. If there are taxes you should have collected in this particular law, right? Taxes should have been collected but weren't, then they can come after you, right? And do that, right? And notice the deficiency issued to Pit Pro became final. Then that led to the going against Ms. Wageman, again, for her, kind of indirect fact that she was a responsible person. She didn't see these taxes had been paid by the corporation. Now, she requests relief, and she claimed that she lacked actual knowledge that Pit Pro's taxes were not being paid when she had the authority and ability to pay those taxes. Now, the OTAs looked at and said, well, there's going to be 4 conditions for personal liabilities under the relevant California RT&C section 6829. There has to be a termination of the business. Check, that's happened. Number 2, there has to be a failure to remit collected tax or pay use tax. In this case, it's going to have to, basically for those, well, no question about that. Number 3, she must be a responsible person, meaning she had to have the authority, right, and the ability to pay the taxes. And if she agrees she did, right, that was there. But number 4, they have to show a willful failure to pay over the taxes. And she's challenging and saying, number 4 isn't gone here because I didn't know they weren't paid. I didn't know. I cannot willfully not pay a liability I didn't know. So the question becomes, is she correct? Is California out of luck because it wasn't willful? Now, the willfulness test requires an intentional, conscious, and voluntary course of action. And generally, there are three tests you got to meet. You got to have actual knowledge of the unpaid tax. You have to have authority to pay the tax in question and the ability to pay. Now, again, she conceded that she had the authority to pay and she had the ability to pay. But what she said was, I wasn't aware of that because until the examination took place, I didn't know that there were sales taxes that should have been collected or use taxes that should have been paid over to the state. I wasn't aware of that fact. And therefore, I can't possibly have willfully failed to pay them because there was no liability until the state came in. At least that's her view. But in this case, basically the OTA points out, the knowledge can be based on circumstantial evidence or willful blindness. And they're going to say that circumstantial evidence suggests that Ms. Wageman should have known that clearly there was a huge amount of unreported sales on which taxes had not been collected or paid. That she, in essence, you can't be this stupid, right? It's one of those things where, you're going to kind of say, yeah, no, I didn't know about it. I said, no, we don't buy that you're that stupid, that you couldn't have shouldn't have been aware that this indicated wildly that there were just uncollected taxes being paid or uncollected tax out there. So the OTA found Ms. Wageman's arguments about lack of knowledge unpersuasive. And there was a number of reasons why they couldn't believe she wasn't aware there was something going on. Number one, she was an equal owner with her husband, and she had a number of roles as an officer of the corporation, including as CFO, right? She had responsibility for tax compliance, right? She was one, that was her job, to comply with the taxes. They made all kinds of purchases that, where they said, oh, we're exempt from sales tax, gave the resale number, etc., and used it for personal purposes and other things, and they never made use tax reporting, which, they say, hey, that's a problem, right? You should have known that. The big negative they had was a significant discrepancy between cost of goods sold and taxable sales. Again, they're losing money on everything they're doing. If you believe them, they have like a big negative margin. And the OTA had trouble believing that she didn't understand that wasn't what was happening, right? She was involved in the financial matters of the company deeply, so she should have been aware of this, right? She couldn't explain where the tax numbers came from. She was in charge of tax reporting, but she couldn't explain where they got their numbers. That's kind of bad. And it should have been clear there was substantial underreporting going on. So for all these reasons, OTA said you were aware there was a huge tax liability. You may have been playing the audit lottery. They didn't really say that, but I'll say it, and assuming the state will never catch you. But as they would point out, that liability existed at that time. It did not wait and only come into fruition when the state of California came in and did the exam. That wasn't when you discovered it. So they concluded she had actual knowledge of the unpaid taxes at a time she had the authority and the ability to pay. She was president, she was CFO, and she had the authority to get the taxes paid, and she had signature authority on the bank account, so she could have made sure they were paid. And the problem with any of these responsible person penalties is if you allow someone else to be paid at a time you owe these sorts of taxes, trust fund taxes to the IRS, these sales taxes to many states, that is considered to be willfully failing to pay over the tax. Nobody else gets paid. That includes payrolls don't happen. I realize there's going to be problems with that, but all those things are true. I think she had kind of considered that since they immediately shut down as soon as the state of California came in and said, you owe us all this sales tax. Oh, isn't that terrible? We'll just shut the door. That didn't protect her. And we're going to find a federal case where putting an entity between you and the problem didn't really solve the problem. So the OTA held that all conditions for personal liability were satisfied and sustained denial of her petition. Right. Now, if you're advising taxes with closely held corporations, and while it's a California case, these concepts are going to apply in a lot of other cases, and you need to be aware of this fact. Understand what, for the tax in question, what makes somebody a potentially responsible person. That is somebody who might have to personally pay over these taxes if the company doesn't, right? Make sure that people who are potentially in that position to get sales and to get basically these taxes paid over, that they monitor the compliance with reporting and paying of those related taxes. Otherwise, you're going to find the case that the court will say, look, you were the CFO, this was your job. If you truly didn't know about this, it's because you decided not to know about it. Not because you didn't fulfill your duties, tough luck. Highlight the risk, with discrepancies in financial reporting. Does your cost of sales, do your margins make sense? Especially if the margins are negative. Yeah, that suggests that there's something going on in the company, right? Make sure you stress the need, as always, for maintaining adequate records. And, if in fact you've got a case where you think there are large audits or potential liabilities out there, to get professional advice. Get this done. Don't just, this gives all the signs in some ways as a do-it-yourself method of, hey, well, we'll just close it down and yeah, they won't be able to come after us for us, right? And remember, in this case, the OTA and most other states, to be honest, will consider circumstantial evidence and overall operation financial knowledge of responsible persons when assessing is there a willful failure to pay. Playing ostrich, putting your head in the sand, is not going to work. Okay, next up, this is actually plaintiffs we've talked about before in this Arizona case. But we did have a decision come down from the court in the case of ERC Today LLC versus John McAnally. In this case, this is from a U.S. District Court here in Arizona on April the 7th, case number CV2403178. So let's talk about this case. This is an employee retention credit case for an employee retention credit consultant. Okay. Now, the employee retention credit, which lived outside the code for most of its time during the pandemic, but for the last 2 quarters did move into the code at Section 3134, but it was enacted under the CARES Act to provide financial stimulus during the pandemic. As we all remember, they retroactively amended the ERC statute multiple times. They expanded eligibility and credit amounts, right? And because of that, especially for 2020, pretty much every employer that got in essence, a PPP loan and it could qualify under the rules for the employee retention credit had to file an amended 941, which, as you should be aware, is only processed by the IRS in paper form. So now a huge flood of these paper 941Xs came in. And as you might guess, that really didn't move very quickly through the IRS systems, right? All that paper, because we also had just the standard backlog of all this stuff that the IRS hadn't dealt with during the pandemic while offices had been closed. So we had a total mess there, right? So with that surge of claims, and after they had been paying them, trying to rapidly pay them, coming to the conclusion there was a lot of fraud going on at this point, they issued a moratorium on processing new claims in September 2023. They then later on in early 24 implemented a new processing protocol called disallowance during processing reopen, or risking, that used automated filters to deny claims. We talked about this before. This just uses the computer, basically scans it quickly, and if it looks like a type of claim that's probably fraudulent or, at least not going to go in the view of the IRS, then the computer, without any person looking at it, just would issue a disallowance notice. These disallowance notices letters 105C and 106C, began being issued after the moratorium was lifted. Now, the plaintiffs are the ERC Today LLC and Stenson Tamadon, tax preparation firms who'd been involved in contingent fee ERC, employee retention credit consulting, where they would go to a company, approach a company, right? Could be email, phone, however they did it, and they would, basically say, hey guys, we'll go ahead, we'll do an ERC study, and we'll give you this, we'll help you file the forms, etc. And then when you do that, we'll give you that information, and we'll go ahead and we'll take a percentage of the refund, right? That's how they do it. Now, as you might guess, they alleged harm from the automated denial of eligible claims, especially because these guys had promised to pay for representation, represent the claimants in audits, etc. And now they're finding all these automated denials, which means they've got to start, at the very least, an appeals process. And as we've discussed before, because the way the timing works on this, within 2 years, and you start looking at these numbers and going, well, they're not going to get to this in 2 years. If we don't get an extension of statute, we're going to have to pay to go to district court and sue for the refund. So obviously that kind of crimped their style, to put it mildly. So these two entities sought a preliminary injunction to compel the IRS to cease the automated denials and restore the prior procedures, which, as we said, the service had been kind of issuing these under the trying to get them out the door. And they can't use automated, and the idea would be, well, we just want the money to come, please. Understand the point. So the court first addressed standing. In order to have standing, you have to be injured, pardon me, have that injury caused by the action of the party you're suing, and have a way the court can address the issue that would solve your problem, called redressability. Okay. Now, the court was fine with injury and causation, right? Because these consultants, their fee model meant that when payments got delayed, it was going to really, really negatively hurt their cash flow. And when claims were denied, remember, then they had to spend money to represent these people, through the process. It could take a long time, potentially even having to pay to go into the district court. And, that was obviously going to be a major negative. So there's no question there's a major negative here. And there is no question that the new process the IRS were using was causing some real problems for them, right? But the court found the plaintiffs failed to make a clear showing of redressability. They said it's speculative whether changing the IRS procedures would lead to a higher rate of approved claims for their clients, especially given all the reports, which the court did pay attention to, from the Treasury Inspector General's office, of potential over-approvals previously. So what they said was, you can't just go back to what we had before. What you have to do is, in essence, the IRS wouldn't go back to that. So there's no guarantee if we say, hey, you can't use this risk-based modeling, that it would speed up processing. In fact, it could very well slow it down even more. Now, the taxpayers, the court looked at the concept of sovereign immunity and due process. Generally, the concept of sovereign immunity, you can't sue the king. In this case, the government stands in for the king, unless the king, the government, grants you permission. Congress passed the Administrative Procedures Act, which does apply in some cases to give you the right to sue the government. Now, in this case, the plaintiffs here brought their claims under the Administrative Procedures Act. Now, for judicial review, in essence, for the waiver of sovereign immunity to take place under the APA, you have to have a final agency action. If you don't have a final agency action, you cannot use the APA to come into court. And this, the court found, was a problem. The IRS's procedures for processing ERC claims did not constitute a final agency action. The final agency action is the actual allowance or disallowance of individual claims. It's when the final action took place. They also noted that the taxpayers have alternative remedies. If they have a disallowance, they could appeal the disallowance. And even if they don't have a disallowance, but you've had a claim for refund in for 6 months, you can you can already go to court to get your money. So they said because, and that's also part of APA, you've got to have no other reasonable route to pursue relief. And they said, you've got 2 routes there. You can get to court. You just can't get to court on this. You'll get to court on the actual claim. Of course, that doesn't really solve these consultants' problems because you got to pay for the attorney. Remember, they'd agreed to kind of do that. But they said those are there, so the APA only comes into play if there aren't alternatives. You can go to appeals if you have a denial, or you just go to court as long as your claim's been there for 6 months, the IRS hasn't acted. And you have to go to court then 2 years after you get a denial. Remember, or get the statute extended. The plaintiffs also asserted a Fifth Amendment substantive due process claim, arguing there was an arbitrary denial of their client's property interest. The court wasn't sure there's protected property interest in an unapproved tax credit claim. They thought that was kind of an odd definition, but secondly, they also said the plaintiffs in this suit weren't the ones who had a potential Fifth Amendment due process claim. It was their clients. You can't assert, you can't kind of use that to bootstrap your own situation. They're saying, nope, even if we decide those unapproved tax claims are property rights, you're not allowed under prior precedent to use your client's problem as a way to get your own matter into court. So, key implications of this. The court denied the plaintiff's motions for preliminary injunction primarily due to failure to demonstrate that anything they do could have, redressed the failure, right? There's no obvious way that even if we barred them from using their risk-based method, that would basically make claims go faster and get these guys the money fixing their problem. They also found the plaintiffs were unlikely to succeed in their APA, Administrative Procedures Act, and due process claims. So, those two ways in wouldn't work, because the big problem they really have there is the final actions are on the client, right? And the client has alternatives. And, and like I said, when you're trying to do due process, you can't go to court and say, you got to let me in because this guy over here has his due process being violated. Now, you kind of need to show yours is being violated, and they said you really didn't do that. Important considerations if you still have clients with ERC claims that are still out there that are being processed. Keep your eye on the IRS's risking methods. You have to understand that. In essence, the way it works, as the taxpayer advocate complained, is you're going to get a disallowance right away. No person's looked at it, and while you can then go to appeals immediately then send it to exam, and an exam's going to finally work the case. And the problem is that 2-year clock is running, though. The disallowance is going to only give you 2 years to get court, so you got to really watch statutes on that. Be aware of that. You got to really manage clients' expectations. The likelihood and timing of refunds. If they got them out there, it's still likely to, they're moving faster on the ones they approve now, but, there's still a lot backlogged and a lot of problems. There's going to need to be due diligence to ensure eligibility and robust documentation. And it's not a bad idea for clients who still have them out there to look at it now. If we get a disallowance, especially if you weren't involved with the initial claim, and now they can't find whoever was, is it going to be worthwhile to pursue this? How much work is it going to be to get the record together? Was there any record whatsoever? Was any decent report left to you by the consultant if you can't find the consultant? And also, what happens if the consultant, due to these cash flow problems that are serious, is unable to make good on their guarantee that they were going to pay for representation? If the client has to pay for it on their own, is that going to make sense? And that really is going to take a look at probably discussing quickly with counsel as well. What's the chance we succeed, and how much is it likely to cost in pursuing this thing if we do, and make a decision right now about what's going to happen when you finally get the allowance or disallowance. Obviously, if you get an allowance, fine, cash the check. If you get a disallowance, the clock starts immediately, and it's probably best at this point to have a clue what you're going to do, right? And also recognize limitation on third-party standing for tax advisors. This is, and we know the IRS is not a fan of contingent fee structures for things like this, but it does indicate one of the problems you've got with a contingent fee arrangement, right? This is a major problem, that contingent fee arrangement structure doesn't work really well, if the IRS is not fast at handling the claim. And as we've discussed before, they really don't have any pressure they really don't have any law that forces them to process it quickly unless you are willing to go to court. The right to go to court after 2 years, is generally what is your out. But the problem is, if you have a right to go to court after 2 years, that means litigating, and that normally is not something that your client who did their claim for refund saying, well, I can't afford to pay you until, this claim comes through. You're probably not going to find many attorneys willing to pick this up on a contingent fee unless they look at the case and slam dunk. And that then becomes a problem. They're not going to take the risk on it, and that means you may have to make a decision what to do. So be aware of that. Okay, what does it mean to fully pay the tax before suing in district court of claims? Look at that in a tax refund suit, the estate of Robert Armitage versus United States. This is case number 24-1687 from the Court of Federal Claims, and the decision was filed on April 7th of 2025. Now, this is a case going on a foreign tax credit claim. And Robert Armitage filed a suit seeking a 2017 federal tax refund based on a foreign tax credit claim. He filed an amended return in 2019 reporting increased income from the transition tax under 965 and claiming an offsetting foreign tax credit under Section 960. Now, because of the late election, we get into all kinds of weird problems he's got, but essentially he's going to pick up a huge chunk of income, and he's going to say, well, it should all be taken care of by the foreign tax credit, so they should have qualified for it. Now, the IRS took a look at his revised return. They denied the refund claim because he wanted some money back. They cited the lack of an election statement and late filing without proper substantiation. Now, the IRS wouldn't give on this, and this is not, because it was a claim for refund, you're not going to tax court. So he had to file suit in the Court of Federal Claims. That's where he chose to go. He could have gone to his U.S. District Court as well. He says amended returns as satisfied the administrative claim requirements of 7422A. And unfortunately, while this is going on, Mr. Armitage died. So his executors basically took over this suit for a refund, right? This refund suit, which actually is primarily looking at avoiding having to pay a lot of tax. That's really at the end of the day what's happening. Now, as we said, the taxpayer's request for relief and the court's analysis of does it have jurisdiction in the case. The estate sought the 2017 tax refund based on the 960 credit claimed on the amended return that the decedent had filed before he died. The estate argued the amended return satisfied the administrative claim requirement or 7422 before you can go to court. They said that is true despite the fact they did not fully pay the assessed transition tax. Right? They filed an amended return, reported they owed that much more tax, but claimed it was offset by a refund. And because they had, they had paid, quote, the amount due on the amended return after netting the credit, that means they had paid the tax, and so now they're entitled to go to court. Now, the United States moved to dismiss, saying, hey, lack of subject matter jurisdiction because they didn't fully pay the tax. Now, the court noted, it is the estate, the plaintiff, that bears the burden of establishing there is subject matter jurisdiction, that the court has a right to hear the case. And the court outlined there were two key jurisdictional prerequisites for a tax refund suit under the Tucker Act. First, you have to have fully paid the principal tax deficiency. And secondly, you must meet the due date for filing your refund claim with the IRS under 7422A, and that is jurisdictional. Okay. So how do we apply the laws to the facts? Well, the court found that Mr. Armitage failed to meet the full payment rule. Again, he doesn't do that, court can't hear the case. While he paid the tax calculated on his amended return, net of the claim credit, he did not pay the $252,118 tax assessment made by the IRS. The court stated that Mr. Armitage was required to pay that IRS assessment in full before challenging its validity in court. The IRS said, you owe us $252,118. If you want to challenge it, because this is not a tax court situation, because this case can't go to tax court, it's a claim for refund. Because of that, you have to pay that and then sue for a refund. And Mr. Armitage, you didn't pay it. And the court stated, that was required. And the fact that some tax documents showed zero balance due was immaterial because the dispute was about challenging a liability without having paid it. The court cannot award for a refund for money that has never been paid. And a 252 has never been paid. They can't order the IRS. You're suing the IRS for $250,118, but you never paid them that, right? They can't order that. And they cannot issue a declaratory judgment on the tax liability. That's also not allowed under Section 2201 of the Internal Revenue Code. The tax court can say you don't owe the tax, right? But the Court of Claims, U.S. District Court, rule on a liability, and a refund. They don't have the right to rule you don't, a declaratory judgment only, when there's no refund case in front of them regarding the tax liability. They don't have that right. So the Court of Federal Claims granted the United States motion to dismiss for lack of subject matter jurisdiction due to noncompliance with the full payment rule. It wasn't enough to fully pay the tax due shown on the amended return. When the IRS disallowed the credit, saying, okay, we'll accept your amended return, but we're not accepting the credit, you had to pay now in the full tax before you could sue. Now, tax professionals' takeaway from this on refund claims, going to the Court of Federal Claims or, frankly, the U.S. District Court, if you're going to do that, the clients must fully pay the assessed tax liability. And again, this is the case if you file an amended return, the IRS accepts part of it, but disallows, let's say, something that's going to increase the tax. The fact that you paid the amended return number, balance due, is not going to satisfy the full payment clause, full payment requirement to get in court. Those existence of offsetting credits or dispute about the taxpayer assessment validity does not circumvent the requirement. You have to pay and ask for the money back. Right? And make sure you properly and timely file an administrative relief claim to the IRS in accordance with 7422A relevant regulations to make sure also, don't forget, fully pay, but you also have to file a claim and ask for your money back. And if you don't meet those hurdles, your case won't be heard by the court. So it's important to keep all that in mind. Okay, let's look at dependents, because this is something that clients often had trouble with. We're going to look at Correll versus Commissioner, Tax Court Matter Decision 2025-31, case issued on April the 9th. Melissa Correll was a non-custodial mother, claimed dependency and child tax credits for a middle child, referred to as child number 2 in the case for 2021. Child number 2 resided full-time with his father in Georgia, while she lived in Florida. So kid was with dad most nights during the year. Despite a past agreement allowing her to claim child number 2, informal agreement between her and her ex-husband, the revised agreement, that the paper agreement they had, entitled the father to claim him. And in 2021, both parents claimed child number 2. Now here's her problem. The law on this is very, very straightforward. The tax court, Congress got the tax court out of making calls about having to read divorce decrees, other sorts of things, determine who gets a child. Simple rule. If both parents provide over half the support, then the parent with whom the child spent the most nights during the year, the majority of the nights during the year with, is considered the custodial parent. It doesn't matter what the state decree says. They're considered custodial. And they get the dependency exemption, or they get, in this case, child tax credit. And the other parent can't claim that unless the now determined to be federal custodial parent signs a release. And it's submitted with a return. So this is where Melissa's going to run into trouble. She's going to fail on all counts. And it doesn't matter that her ex had allowed her to take the kid for all the prior years, doing none of that. He was the one that was going to win in this one, and he does win. Now, as the court noted, the commission determination presumed correct. The taxpayer bears the burden of proof. They recited the standard line from the Supreme Court: deductions or credits are a matter of legislative grace. Taxpayer bearing the burden of proving entitlement. And IRC Section 151 A and C allow a deduction for each individual who is a dependent. Now, we know now it's not a deduction. It actually gets a child credit in the interim short term. Maybe in 26 it changes back. Who knows? But dependent includes a qualifying child as determined under Section 152A1. And a qualifying child in 152C1B must have the same principal place of abode as the taxpayer for more than one half taxable year. Child 2 did not meet that requirement for the one suing here, right? The tiebreaker rules in 122C4B for parents filing separately were not applicable because there was no dispute of where the child resided longer. And the exception for non-custodial parents under 152E requires a written declaration from the custodial parent and attachment to the claiming parent, the non-custodial parent's return. She didn't do that. She didn't get that waiver from him, and she didn't attach it to the return. Gang, these are the only relevant facts. Now, the fact that their written agreement would have given it to the husband anyway, ex-husband, that is only indirectly relevant in the sense that what the tax court would say, she should have taken him to court if, in fact, he was supposed to, under the degree, sign over the exemption to her. She should have taken him to court and basically gotten a court order in the state court ordering him to sign, and the courts will sit there and make the person sign, and take that. But the federal courts aren't going to touch that one. But as we've already noted, the written agreement, she wouldn't have won on that either in the state court. So she really had no way to get this exemption. As soon as the husband put the child on the return, her credit went away. So the child tax credit, Section 24A of the IRC allows child tax credit for each qualifying child, for which the taxpayer is allowed deduction under Section 151. A qualifying child is defined on 152C as not attained to age 17. And the burden of proof did not shift to the commissioner here. The burden of proof is on the taxpayer. In this case, because they are proving the deduction, they're proving the credit. And yeah, she just really couldn't. Because child number 2 did not live with her for more than half the year, he was not her qualifying child and therefore could not be on the return. The non-custodial parent exception not apply because she didn't have a written declaration and she didn't attach to it to return. She was not entitled to dependency deduction. Because of that, she couldn't get the child tax credit. End of case, end of day. This case highlights, for those in tax practice, the strict requirement for change claiming a child as dependent, especially the residency test for qualifying child. Where did the child stay? The place the child was at the most nights, that parent is in control of this. I don't care what your divorce decree says. The federal court's going to ignore that until you come in with this signed document. So if dad's supposed to do it, but dad doesn't sign it, as happened in this case, well, dad wasn't supposed to do it. That's one of the problems. But, you take dad to court and say, per the agreement, you're supposed to release this. We find you should have done that. So you either sign this here right now, or we're hauling you off to jail for being in contempt of court. Your choices. Make sure your clients understand that. Ex-spouses love to do these side deals. And yes, the IRS's systems are broken in this area. And essentially, as long as nobody files otherwise, as long as only one parent claims the child, the IRS is not likely to ever raise a fuss. But that other parent could file a amended return at any time and claim the child. And, the taxpayer who went ahead and filed without that document, they have no recourse. They're done. So make sure you adhere to statutory requirements. Get the documentation of Form 8332 when a non-custodial parent intends to claim the child as a dependent. Well, by the way, if the custodial parent signed the 8332 and the decree says they're supposed to get the dependent, the court's going to probably say, well, you signed that, said it was okay. We're not changing. We don't care what your decree says. And the state court's going to have a troublesome, probably, unless there was some sort of fraud perpetrated, ordering the current taxpayer to remove them or do something of that sort. It would be a problem. Let's talk about a charitable contribution deduction for donation of art. The WT Art Partnership LLP versus Commissioner. This is Tax Court Memorandum Decision 2025-30, issued on April the 9th. Now, WRT Art donated 5 early Chinese paintings to the Met, Metropolitan Museum of Art, between 2010 and 2012, declaiming donations exceeding $73 million. They got appraisal from China Guardian Auction Company Limited, somebody who they've used before. They attached that to substantiate the value. Now, the IRS examined this return, and this time they disallowed the deduction, arguing that China Guardian was not a qualified appraiser and a qualified appraisal was not attached, which would totally disallow the $73 million deduction. The IRS also contended the paintings were overvalued. Now, at the end of the day, we're really fighting over one painting. The parties agree on the fair market value of the 4 paintings. The remaining issue concerned whether the appraisals were qualified, whether there's reasonable cause for the failure to attach a qualified appraisal, the fair market value of one of these paintings, Palace Banquet, and a discount for lack of marketability and actually related penalties. These are the key facts in question. Now, the key requirements per the court. In non-publicly traded property that has a value over $500,000 claimed on a income tax return as a deduction, you must attach a qualified appraisal by a qualified appraiser. Must be obtained and attached to the return. A qualified appraiser is an individual, which is going to be key here, with specific qualifications, demonstrable education, and experience in valuing the specific property, who rarely performs appraisals or holds himself out as an appraisal under the code and regulations. Now, if it turns out you didn't actually attach a qualified appraisal, you can still get away from that total disallowance if you can show the failure to obtain a qualified appraisal can be excused if due to reasonable cause and not willful neglect. It required exercise of ordinary business care and prudence by the taxpayer. And finally, the valuation of charitable contributions, is generally fair market value at the time of gift. And for art, comparable sales methods are normally used. Now, the court agreed with the IRS that the China Guardian appraisals were not qualified appraisals because the individuals involved who signed the report were not themselves qualified appraisers under the rules under 170 F11EII. China Guardian as an entity could not be a qualified appraiser because it was an individual. It doesn't have education. And Ms. Wang, who signed on behalf of China Guardian, lacked demonstrable expertise in valuing these paintings. However, the court said we're not going to fully disallow the deduction because it was reasonable cause for not having a qualified appraisal attached. Mr. Tang, who was the person, involved with making the judgments for WRT Art, he had a good faith belief China Guardian was reputable based on recommendations, right, from various parties that, had donated these types of artworks to museums in the past. Information from the Met about China Guardian, right? The lack of challenge in a prior IRS exam where they'd used this same organization to value the paintings, and a favorable settlement, not only that, in that exam. The court noted past experience with the IRS can support reasonable cause. It won't change the result necessarily in a case, but it can be reasonable cause. In this case, we're saying, yep, it's reasonable. Now, I should add, at this point in time, if let's say, they were now going to, let's say for the 25 return, they're going to be making another such charitable contribution. In that case, they now know that China Guardian by itself is not going to be a qualified appraisal, and they're going to have to get to make sure whoever signs that on behalf of China Guardian is themselves a qualified appraiser, and meets those requirements. So now they have knowledge, and they wouldn't be able to claim reasonable cause any longer. But up until then, they're probably covered by this for any later ones they did. However, the court determined the value of Palace Banquet to be $12 million, right? The taxpayer claimed $26 million. Slight difference in value there, right? The court concluded in another issue they fought a bit over, Palace Banquet was not subject to a legally binding de-accession restriction. That's a restriction which is involved sometimes with gifts to museums where the organization cannot take the painting out of, in essence, they can't sell the painting, without getting permission. That is, or take it out of the collection. So, was it subject to that? The court found no. So so the IRS was wrong there in that regard. But because the claim value exceeded 200% of the correct value, a gross valuation misstatement penalty of 40% of the tax reduction that came from overstating that value does apply. And you might say, but we had reasonable cause. We thought these guys were good guys. The problem is, for that penalty under 662H, the reasonable cause exception specifically is not available. For gross valuation misstatements related to charitable deduction property under 6064C3, that you're just strictly liable for that penalty. If it is grossly misvalued, you're going to get hit with a 40% gross valuation misstatement. No penalties were sustained for 2011 and 2012 because those were the years where they had agreed upon fair market value and reasonable cause for believing China Guardian was qualified. So that year, but the donation in 2010, which was Palace Banquet, that one, yeah, they're going to get nailed for this penalty. Now, what this does, WRT Art Partnership Limited Partnership, highlights the stringent requirements for substantiating charitable contribution deductions of high-value property under 170 F11. If you have a client giving property worth over $500,000, we need qualified appraisals from qualified appraisers. We need to do enough looking to try to make sure they are qualified appraisers, right? You need to do some background. In this case, WRT Art did the background work. Yeah, they didn't get it right, let's say, because they didn't push far enough. But clearly, the IRS even ignored the issue in the past, didn't really go down this path. So essentially, they were okay, but you need that level of due diligence. Had they simply said, well, okay, China, you go ahead and these guys will do it. Yeah, that probably wouldn't have been reasonable cause. Again, while the reasonable cause exception can provide relief from total disallowance of this high value contribution, it does not help you with gross valuation misstatements and the penalties. Those will still apply regardless of how good of faith you were in, how much reasonable work you did, how much groundwork you did. It doesn't matter. If the valuation is off, by over 200%, by more than 200%, you got a problem, right? You're going to owe it. You got to make sure you have well-reasoned and well-supported valuations. And certainly you don't just want to go with the highest party, who gives us the biggest number. Because that'll definitely get rid of your reasonable cause right away. I'll tell you right away, I'm pretty much on that. But secondly, you got to say, you have to be a little bit saying, well, why are these guys so much higher than the others? If you got things like that. And you want to make sure you check with people who should know who are good in this realm. Pretty much do what WRT Art Partnership kind of did. As I said, yeah, they didn't quite get it right. And certainly for gross valuation misstatement. But see, it wouldn't have mattered. They could have been a qualified appraiser. It wouldn't have solved that problem. So be around this. And remember, if you have improperly substantiated and accuracy valued charitable contributions, you can lose big. And the IRS is getting very good at checking on these things. So be careful. Let's talk about Zajac versus Commissioner. Okay. Tax court disallows a whole number of deductions, upholds penalties. Tax court ran in 2025-33 on April the 10th. This taxpayer had a bunch of things disallowed. He had a Schedule C, business deductions. He lost car and truck expenses, depreciation, legal and professional fees, meals and entertainment, rent, travel, moving expenses, charitable contribution, job-related expenses. And fundamentally, all of that falls apart due to lack of documentation. Give you the quick things. They also determined he improperly excluded settlement proceeds from gross income related to a 2004 arrest. Now, he did partially win on that last issue. The court decided basically that half of the settlement arrangement were physical injuries because that was claimed, and the court determined that the city did pay this because of physical injuries to some extent, and partially for other claims. So the court did a Solomon split the baby down the middle routine, right? Split it down the middle and gave him half. That's the only thing he really won, right? Under Section 6001, the court recited the taxpayer must prove entitlement to deductions and must maintain sufficient records. Moving expenses were disallowed because he failed to meet the time test and had insufficient substantiation. He failed to keep contemporaneous mileage logs and exceed the base of depreciation under his vehicles and depreciation on assets there, so those got disallowed. His legal and professional fees were held to be personal in nature under the origin of the claim doctrine from the Gilman case and not connected to his consulting business. And insufficient records exist to apply the Cohen rule for how much of the legal fees represented things related to that settlement. That was includable in income, We couldn't figure that out because, again, we didn't have records. Meals, entertainment, and travel, again, failed to meet the strict substantiation requirements for those under 274D. So it's a problem. Clients do this all the time. He tried to take a write-off for the value of his time for clients didn't pay him. The court noted you have no basis in that, so no issue. And he also claimed separately deduction for rent and utilities, but those are already accounted for under the home office deduction. So it disallowed that as double. And on charitable contributions, what did I say about bad records there? In this case, his donation to Ginny's Helping Hand was disallowed for lack of temporaneous written acknowledgement, where they have to give that thing with all the proper documents, including that you got nothing or the value of what you did get. And donation to the Cell Phone Recycling Center was disallowed because he failed to prove it was a qualified organization. You have to get to a 501c3 charity, and he didn't show that it was. He also improperly claimed job and miscellaneous expenses on Schedule A. He had no substantiation for anyway, so yeah, bad. Not surprisingly, the court imposed a 20% accuracy rate penalty or 6662A for negligent, disregarded rules, regulations, or a substantial understatement of income tax. The commissioner met the burden for production penalties of 7491C, including supervisory approval. And fundamentally, this was TurboTax did it, was the defense Mr. Zajac tried. And the court has said, sorry, that's never reasonable cause defense. Citing the Bunny and Morales cases, that doesn't work. So the tax court basically sustained commission determination on settlement proceeds, half of it, the disallowance of all disputed deductions, and the imposition of action-related penalties. Key issue for taxpayers, got to have records. The main reason you're going to lose in tax court, the main reason you're going to lose on exam is lack of records. You need records. Clients who don't keep them will suffer for it on exam. They need to understand that. It's not going to work to their advantage normally. Yes, Cohen sometimes comes to save you, but Cohen even needs some backup, something to give us a reasonable basis. And so the problem is too often clients don't have anything, right? If you're going to do a legal and professional fees, you've got to understand the origin of the claim doctrine. What created the legal claim? Was that primarily personal in nature, business in nature, or what? That's what you look back to the origin of the claim doctrine. And that determines if legal fees are deductible. Legal fees are generally not deductible. Keep that in mind. You've got to show that the origin of the claim ties in some way into this in a way that makes it tax deductible. So what originated the claim? Make sure you apply the specific code sections and regulations for each type of deduction. The special rules under 274D, the charitable contribution documentation requirements, right? All of those things, make sure you apply those rules. And you can't rely on tax prep software. Now, as a tax pro, you probably should be aware of that. I do want to remind you that also means that you really have no defense saying, well, that's how UltraTax did it, or that's how, that's how Lacert did it, or ProFX did it, right? That's not really a defense. So they won't be in your liability trial, so be aware of that. And so you want to make sure you advise clients. Do your clients know about the importance of keeping records, right? So they understand the problem here. Do they understand why not all legal expenses are deductible? And conceptually, why we have to go back to why did this claim arise? Did it come out of a personal activity like a divorce? Did it come out of a business activity like the fact, you're operating your candy store, somebody slips and falls in there, and sues you as a business because you made a reckless area for kids? That's a different origin of the claim. And that's going to be key. Hampton v. Commissioner, another case of trying to an entity to solve a problem you've got. This is Tax Memorandum 2025-32. This is a disallowance of a shareholder's loss deduction flowing through a Ms. S Corporation following assets forfeiture that related to some bad conduct on the taxpayer's behalf, where they went in and they seized assets of his wholly owned corporation in order to satisfy the court's order against him. Now, Douglas Hampton pled guilty in 2013 to bribery, fraud, and money laundering. Okay. He was ordered to forfeit approximately $2.2 million in income and wealth from his criminal activities that he had earned. Now, he operated a financial services business through his wholly owned S Corporation, Hampton Capital Management. In 2016, U.S. Marshal Services seized $865,029.57 from HCM's bank account as substitute property under Title 21 United States Code, Section 853P, to satisfy his forfeiture liability. Now, taxpayer then took claim to loss deduction on the S-Corp return of $855,882 related to seized funds under 165. Hampton, as the sole shareholder, reported that loss on his return under Section 1366A as flowing through from the S Corporation. The IRS disallowed the deduction on Mr. Hampton's return, citing public policy reasons. The court noted again, general presumption is the commissioner's determination is correct, taxpayer's burden of proof. Now, the court noted, goes through a bit of history of this whole public policy rules and the codification in 162F. And while 162F codified the public policy doctrine for business expenses, disallowing fines and penalties, judicial policy doctrine, which was the predecessor in which it codified, still applies outside that context, right? And so it still retains vitality for deductions under 165 that don't get caught by 165F and get disallowed. And forfeitures in connection with a criminal conviction are generally penalties for which a deduction would frustrate public policy by reducing the sting. This comes from the tank truck rentals case, right? We're meant to, that forfeiture was meant to sting, basically punish Mr. Hampton. And if we allow him to claim a deduction, we're reducing the sting of that. Now, Mr. Hampton said the public policy doctrine should not apply because the corporation was never charged in any of this, right? Now, the court rejected this doctrine, holding that Hampton was barred by the public policy doctrine from reporting his pass-through share of the loss that related to his bad conduct, right? A seizure of assets that were ordered because he was dodging, paying it over, and the judgment related to his bad conduct. Sorry, that's still tainted even if you run it through your S-Corp. Right. Allowing the deduction would frustrate public policy against criminal conduct because he pleaded guilty to as the seized assets were derived from his illegal activity. Right, he diverted them into the S-Corp. And, that's kind of issue. The public policy doctrine can apply when the penalty is paid by a related entity that's not directly convicted. Holmes Enterprises case is mentioned by the court in this one. The court found that HCM was not a separate person from Mr. Hampton, purposes of substitute forfeiture provisions of Title 21 U.S.C. Section 853P due to his sole ownership and control and derivation of HCM's income from his criminal activity. In essence, it was his alter ego, which is what the criminal court kind of found. The court dismissed his arguments about due process violations or an overzealous seizure, stating such arguments should have been raised in this criminal forfeiture proceedings, right? The tax court cannot review that. Right? You're arguing at the wrong place. You should have argued it in the criminal case or on appeal, whatever there. But you've got now a final conviction. This is a final decision. You can't relitigate that matter before the tax court. The tax court did not look at some of the IRS's alternative theories about why you couldn't claim the deduction. And so it sustained the commissioner's disallowance of the loss deduction. It said allowing deduction would have reduced the financial penalty for Hampton's criminal conduct. Implications, well, public policy doctrine still can reach outside of 165F, right? So it's there. So a related entity like the S Corporation, you can't just transfer the payment there and, kind of wash it clean of the taint. The pass-through nature of the S Corporation does not shield shareholders from public policy doctrine at the shareholder level. Remember, you can't relitigate, especially if you have a client convicted of a criminal offense. You can't try to challenge holdings of the criminal case if they didn't go on appeal and challenge it, in the criminal case to get the position reversed. You're going to be bound by that other case, right? The tax court is not offering an option to relitigate matters, which is what they're going to try to do. If you have this case, and hopefully you don't have many cases like this, but if you do have a client who is facing criminal penalties, and you have anything like this arise, you got to take a look at the nexus between a claim loss and the illegal activities of the taxpayer. Not necessarily which entity was involved, but, look at that issues. And an understanding of public policy doctrine is essential for advising clients on loss deductions. especially those involving forfeitures. And I would strongly suggest, you have a criminal tax attorney kind of look at this, because, we got to kind of understand how this whole thing works, or somebody who at least litigated in the courts on the tax matters to understand the implications of a case like this. We have our new SIFL rates for valuation of non-commercial flights for employees and the like. Revenue Ruling 2025-9. This is for the first 6 months of this year. That was issued on April 11th, 2025. The valuation of fringe benefits, including non-commercial flights on employer-provided aircraft, falls under Section 61 of the Code. Gross income from all sources, however derived. Under Regulation 1.61-21G, there is a rule for valuing such flights when an employee rides along on a business aircraft. The standard industry fare level formula is used to determine the value. This is found in the regulation at Regulation 1.61-21G5. It multiplies the Apple cents per mile by the aircraft multiple and adds the terminal charge. So you need three factors: the cents per mile for that leg, for the length of that leg of the trip, the aircraft multiple for that particular issue, and the terminal charge. The SFL rates and terminal charge are calculated and reviewed every 6 months by the Department of Transportation. This particular revenue ruling will cover the first 6 months of 2025. So it's for updated rates and terminal charges for flights taken during January 1st of 2025 through June 30. During that 6 month period, the terminal charge will be $52.44. And the mileage charge depends on how many miles the leg of the flight was. If it's up to 500 miles, use 28.69 cents per mile. If it's 501 to 1,500 miles, use 21.87 cents per mile. And if it's over 1,500 miles, the leg of the flight is 21.03 cents per mile. So, use the SIFL rates to determine for that first 6 months. Look up those table rates. Find the aircraft multiplier from the regs in 1.61-21G7. Determine the Apple mileage bracket for each leg of the flight. Multiply the per mile rate times the mile in each bracket. Multiply the result by the aircraft multiple. Then add the terminal charge $52.44 to arrive at the taxable fringe benefit. These are subject to change, and where there will be a new rate issued that will take effect July 1st through the end of the year. So we're somewhere in that range. And again, these tend to come out after. It takes DOT some time to do this. So usually you're looking kind of like this, where we're looking at this point, like into the 4th month of the time period before we get the final values to come out. So October would be a time you might see these things come through. They do have a contact if you have questions about this. They actually provide that in the ruling. I note that mainly because lots of times that is provided. It's not a toll-free number, but you can get a direct line to whoever in the Chief Counsel's office was involved in writing the document in question. That can help answer any odd questions you might have. Obviously, if you're trying to value non-commercial flights on employer-provided aircraft, yeah, you should know about this and be keeping up with this. And that's basically, hopefully, you've been doing that. IRS is going to provide limited penalty relief for certain micro-captive disclosure statements in IRS Notice 2025-24, issued on April the 11th. Notice 2025-24 provides limited relief from penalties under 6707A, Cap A, little a, and 6707 little a for participants and material advisors in certain micro-captive reportable transactions. This is one that disappeared and returned to the listed transaction list. Penalty for failure to include required disclosure information with return or statement under 6011 in a later identified micro-captive transaction and later identified micro-captive transaction of interest to miss the original April 14, 2025 deadline. These are ones where these transactions were included on a prior return. You were supposed to have fixed those by April 14th, which obviously if you haven't fixed it yet, you missed that date. And if you are a material advisor, if you miss the April 30th, 2025 deadline, that one you could still make, but if you miss it, you can use this relief. These transactions were identified as such effective January 1st, 2025. So if you did take advantage of the short time that they were not listed to not make disclosures, when they put it back on the list, which we warned you about when they did this, you had to go back now and re-report, and put those reports back on the returns, which is why, I figured a lot of people who were involved in this kind of saw that, knew it was coming, and why would you go back? Why would you leave them off? Just put them on because they're going to have to come back and do the separate reporting, and that was it. But the bad news was the due dates therefore fell within tax season, so they're going to kind of give a little bit relief based on that the advisors might have been tied up. Now, the key requirement to qualify for this relief is the timely file a required disclosure statement with the Office of Tax Shelter OTSA administration by July 31st of this year. You have a July 31st date. If you're a participant, you must complete Form 8886 according to the instructions found. According to instructions, it's under Regulation 1.6011-4D. And if you're a material advisor to such a transaction, you must complete Form 8918 according to the instructions, in this case required by Regulation 301-6111-3D. The relief is limited to later micro-captive listed transactions and later identified micro-captive transactions of interest, where disclosures obligations occurred after the tax return filing for participants or before becoming a provisor for advisors due to the January 15, 2025 identification. Relief is limited only to penalties under 6707 Cap A, little a, and 6707 little a. Other penalties may still apply. The waiver does not apply to any penalty under 6707 Cap A, little a for participants required to file a copy of the disclosure statement with their tax return, right? It had to be a previously filed return where this later came up. That's how it goes. If you're concerned about the original deadline, you should have probably extended this year's return, right, to get that done. Disclosures required on or after July 31st, 2025 remain due as otherwise set forth in the regs. It does not modify list maintenance obligations of children's advisors under 6112 or Regulation 301-6112-1, and it may not apply to taxpayers who have finalized settlement agreements with the IRS or for transactions of interest, those who filed notice 2016-66. So, yeah, if you have a deal already with the IRS, you'll have to see if the IRS is going to allow you to go out and do this to get out of it. May not work. The primary benefit of doing the relief is avoiding the significant penalties under 6707 Cap AA and 607 little a for failing time to disclose participation in these activities. Meaning the extended filing deadline allows the affected parties to come to compliance with these rules. So if you have a client affected by this, you're on a short-term window to get this fixed. Like we said, it offers targeted penalty relief for later identified micro-captive listed transactions. You want to carefully assess if any of your clients, have this problem and did they meet obligations for relief. If you had a client that has this, they're one of those that always brings the stuff in October, but they had this and it wasn't reported, let's say, on last year's return because it ceased to be a listed transaction by the time you filed the return. You need to get back into this for July 31st, okay? Be aware, they're looking, if you have a client affected by this, want a July 31st date. It can't just wait until they finally decide to drop off their tax stuff in October. And yes, people have clients like that. So be aware of that. Remember that the limitations, it does not apply if you failed to put it on the initial return, right? Or if you have ongoing disclosure obligations going forward. This is just the returns that missed it, right? Basically, the ones that, that missed it because, you were there, you basically filed the return, you didn't attach it because it wasn't technically required. Now you discover it is, so you put it on. Those ones it does. And you got to really, really pay close attention to nuances. If you're involved in this, because these are really big penalties, you want to make sure that you have carefully studied this particular notice to make sure you fully understand who qualifies and how to make it work. Finally, you thought this session would never end. I told you it was a long one. The demise of DeFi broker reporting. We talked about this a little bit before, but now it's formally. House Joint Resolution 25 that removed Treasury Decision 10,021 that we talked about at the end of last year. This was House Joint Resolution 25 was signed into law by the President on April the 10th of 2025. This resolution passed under the Congressional Review Act, CRA, disapproved and repealed IRS regulations in Treasury Decision 10,021. That aimed to impose information reporting requirements on certain participants in the decentralized finance or DeFi sector of the digital asset industry. Now, the key consequences of the fact that this has passed and been signed into law. First real key is there won't be information reporting obligations for those DeFi participants that we're going to have to report as brokers. They won't be kicked in under that rule. Also, the IRS cannot, anytime in the future, issue the same or substantially similar rules, right? This bars them from doing that in the future. It's not like, oh, you just got rid of this, we'll put it back in the next time there's a change in administration. Require Congress to authorize that. The IRS will not automatically receive information from these DeFi brokers, but they still have audit authority. Remember, whether or not something's reported, on information return, your client still has to report on the return if it's taxable. And they can still use John Doe summonses to get a list of people who were involved, who the DeFi was involved with, the DeFi broker was involved with. So, tell the client, it'd be best you didn't show up on that list if you haven't actually already disclosed all this stuff. We could see future DeFi products develop because they don't have the burden of having to do this. And the rules for the centralized digital asset brokers, this is not wide enough. The ones that hold the digital coins, they're still going to be reporting, right? That's still going to be coming. Treasury Decision 10,000, that's not affected. That still goes into play. So yeah, it's not like you won't get any reporting on crypto or NFTs. You just won't get it from these people that are kind of removed from the direct holding. Now, this Treasury decision that was published December 30th that got repealed outlined final regulations for gross proceeds reported by brokers that regularly provide services effectuating digital asset sales. It was to apply to sales on or after January 1st of 27. So it wasn't yet in place. It would have been in place essentially for 2 years. It had a definition of digital asset middlemen responsible for providing an effectuating service who would have to report. It talked about a trading front-end service provider and had treatments for them. It talked about effectuating service, including trading front-end services, and excluded certain activities like validation services and licensing, selling hardware for private key control. All of those definitions are going away. They're gone. Had the rule taken effect, DeFi brokers would be required to file information returns, 1099 DAs. Now remember, those who are true brokers are going to file 1099 DAs. And that's the places your clients have these coins on deposit with. They will be filing. But the DeFi broker doesn't have to. Furnished pay statements reporting gross proceeds from digital asset sales would have been required of those brokers, not anymore. Again, the regular brokers will report that. And they would have had to comply with record-keeping requirements to be able to provide this information. Obviously, they don't need to do that. The regular brokers obviously do. The regulations include a position of no standard term for certain providers should identify the selling party and transactions details. Don't have to apply that standard. Again, it was not going to apply January 1st of 2027. And no 25-3 provided certain transitional relief from penalties and backup withholding for sales before January 1st, 2028 under certain conditions. That ruling, that relief on those 2025-3 is now moot because none of this applies. What's the landscape after HJ Res 25's passage? It's a setback for the IRS's DeFi reporting efforts. Not going to have that, right? Centralized brokers are still going to have to report. You're still going to get those, basically those 1099s are going to be coming. But DeFi participants who would have been brokers under Treasury Decision 10,021 are relieved. They won't do it anymore. Okay. So key takeaways for you advising your clients who are in the digital asset space. The specific reporting requirements of TD 10,021 you may have heard about in your tax updates last year. Those will not occur. The IRS cannot issue similar regulations without congressional approval in the future. While direct third-party reporting from these DeFi entities is eliminated, the IRS retains other audit tools, so they still can figure out about it. And a digital asset regulatory landscape remains open to change. Key changes, key issues in this particular structure. Again, remind your clients, even though they won't get a 1099, it does not mean they don't report the income. Right? They still have to report that stuff. right? It's there. And make sure the clients understand they need to personally accurately track and report their digital transactions. There'll be a lot of them if they actually are using things like Coinbase, that might get used to it being much like your brokerage account for your stocks, and where, I don't really need to track that because Schwab's tracking it. I don't need to track that because Coinbase tracking maybe. But if you get involved in a DeFi style transaction, nobody may be tracking it. They really always need to have the records for their digital assets, purchases and sales. Stay vigilant for any future legislative regulatory developments in digital asset taxation. I don't expect stricter regulation currently unless there's some sort of major scandal erupts, right? Some big problem does, then we might see it. But right now, the mood is not for clamping down on this. So I think we may see some release maybe of requirements could be in place. And remember, the clients have to still understand that none of this reporting stuff changes their compliance obligations under the law. Even today, they got to report these sales. Okay? Otherwise, that's called tax fraud. This has been the current federal tax developments for the week of April the 16th, 2025. It was the 14th, but again, that was for the date we could do this, when I didn't really have time to do it. As always, I'm Ed Zollers. I'm doing this from Phoenix. You can email me, edzollers@currentfederaltaxdevelopments.com, if you have any questions. I also am on the Connect groups for the Arizona, New Jersey, Idaho, Minnesota, Illinois, and Washington Society of CPAs. If you have questions, you can post there, and if I see them and I think I can help, I may answer. Otherwise, we will hopefully see you next week, and hopefully we'll actually get some material to work with besides the one case I've got currently, which is a kind of interesting case, but still it's one case. So we'll talk a bit about that. But otherwise, we will see you back here next week on current federal tax developments.